Hello, amazing listeners. Welcome to Property Space, RBC podcast. Today, our guest of honor is Brandon. So, Brandon is from Capricorn Financial Singapore, and he's our money guy, a mortgage broker who specializes in new build financing for non-UK residents. I think generally we have a lot of clients who are looking for financing, not only from local banks, but also exploring options from UK banks. And some of the clients actually have quite a lot of misconception when I have conversation with them. So today, Brandon, you are responsible to address some of the misconception and also some of the expectation gap, because they always have this expectation versus reality. So question number one, could you share with us the general requirements for a Malaysian, for example, when they want to consider a UK loan for their property in UK?
Okay, so before any lending can take place, it's just like when you want to apply a loan in Malaysia, lender has to see comfort that whoever is the applicant, they must have stable income. All right. For instance, if you're on salary, they need to see there's consistency of actually salary being credited on your bank statement for the last 3 months. If you are a self-employed businessman, we need to look into your last 2 years or 3 years of tax returns.
2 to 3 years.
Yes,
Wow.
that's
okay.
correct.
Okay. So I guess the application process is actually quite similar for Malaysian banks, except on the self-employed part. The self-employed part will be a slightly more complicated, I suppose.
Okay, so for self-employed applicants, right? Okay, we need to determine what is their profession, okay, and what do they actually, how do they gain their income from? Is it through contracts or is it through some etc. ways of means? Okay, maybe for example, if the self-employed person is a doctor, fair enough, because doctors are very highly respected profession. We know actually it's like how much they are being paid for and just for a surgery, etc. So from there on, it's very predictable.
Okay.
Okay.
I think banks are generally quite fond of predictability.
Yes,
and also
that's
job
the key word.
security. So, Brandon, generally you're dealing mostly international applicants, and on occasion basis, I believe you are also dealing with British applicants as well. Is there a vast difference in between the rates we as non-UK residents are getting versus the British applicants?
Okay, in simple context, right? Okay, whenever a lender is drafting out a loan, okay, if you are a UK resident, you are on UK soil, okay, they will see more security and comfort should anything go wrong. So to answer your question, usually international clients, you will pay a 0.5% margin or maybe up to 1% margin more expensive than the residents.
I see. So that means that those who are UK residents, anything goes south, right? The bank still can come after you, because they know where you live.
Yes.
Whereas as international applicants, they can't go beyond UK soil. So definitely we are being charged a marginal increase, just
Yes.
a marginal.
Everything is about exposure.
Understand.
Yeah.
Okay. Now, next question is about the interest rates. Oh, so back to interest rates. What is the difference between the fixed rate and floating rate?
Okay, fixed rate, as the name suggests, the rate is fixed over a period, for example, 2 years or 5 years. Okay, if you go for 2 years, for example, your monthly installment is £1,000, it will be fixed at £1,000 for 24 months. Now, moving into floating rate, right? Okay, floating rate, it floats. Okay, usually the bank will charge you a margin, a bank profit margin, for instance, maybe say 1.5% or 2%, plus the cost of funds. Cost of funds here we are talking about is actually, for example, Bank of England. The cost of borrowing is right now at 5.25, which is quite high. And then the bank will charge you a margin, and then you will get your rate that you need to pay. For instance, maybe now you're paying £1,000. If the rate drops, okay, your installment will drop as well.
Understand.
Okay.
So now that under fixed rate, we have the common products that we have been seeing on the market is fixed 2 years and fixed 5 years.
Yes.
So definitely there are all sort of investors in the market as well. So fixed 2 years would be suitable for what kind of clients, in your opinion?
Well, I will always ask what's the risk appetite of my client and what's their main objective when they are actually drafting out this loan. Okay, 2 years product is available in the market right now. However, it is expensive because as we are speaking today, interest rate market is very high. Okay. Now, in comparison to that, okay, if we are to consider a 5-year fixed rate, okay, the lender is able to draft out a much more attractive loan package, meaning to say actually it's like they average out high, high, low, 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 low. Okay, so they will take the in between.
I see.
So you get a 5-year much more attractive interest rate,
So
which is
that's
like
how
a
they
fixed
optimize the
package.
cost of
Yes, cost of funds.
lah. I see. And it's also a general belief coming from our clients that banks will only consider how much of the rental the unit may be possible to generate after
Yes.
completion, and in turn they would have this misperception that their income will not be considered as part of the approval guideline. Is that true? Meaning to say the banks or lenders that you're dealing with will only look at the rental income portion in order to give them the loan approval.
Before a buy-to-let loan can be approved, lender needs to see comfort. So for example, flat A is going to draw £1,000 of rental income, okay? Then from there, your affordability would be, say, for example, £800 per month to pay for monthly installment, okay? So they need to see these numbers gel up before they can dish out a loan. So coming back to your question, whether the income of the applicant kicks in, yes, that is one criteria, but concurrently, the rental income is the main factor.
I see. Would there be any lock-in period for the loan that you're offering to the customer?
Okay, typically for UK lenders, right? Okay, they do offer solutions for example, we are talking about floating rates. We are looking at maybe say a 2-year to 3-year lock-in, whereby the bank will fix a profit margin plus the cost of funds, okay, over 24 months or 36 months. For fixed rates, especially for investors from the region, they have solutions such as 2 years fixed, 3 years fixed, or 5 years fixed, okay?
What are the differences in the interest rate between a fixed 2 years and a fixed 5 years package?
Right now in the market, we all know we are at a record high, okay? So bank sits on deposits, they need to lend out, okay? So right now, for example, we are saying around we are at a peak, okay? In order for the bank to actually dish out a loan, okay, for example, a 5-year loan, okay, they can leverage on actually it's like the predictions of actually rates are going to fall down year 4, year 3, year 2, and then they average out, and then it's still considered one of the cheapest to sign up for a 5-year fixed plan now.
I see. I see. One more question. I think this is generally to do with Asian buyers who are very traditional. Traditional in the sense that they are only looking for principal plus interest loan.
Yes.
Because they think that there is a sense of ownership to the unit they are paying for. Can you tell us why investor should consider an interest-only loan?
Okay, so to put things into context, right? Okay, for instance, buy-to-let properties, we can obtain a loan maximum ceiling of 75%. Okay, now you only need to put down a cash deposit of 25%. Okay, so if we consider the flat is for $100, okay, we just need to put $25 for cash deposit. Okay, your rental coming in every month should pay for your monthly installment for interest only. Okay, if you hold on to this property for 20 years, technically you only come up with $25 of cash. And whatever you collected through the rental income should pay for your installment, your letting fees, etc., and you should have a positive cash flow.
Correct.
So in short, this is preferred by investors because they treat it as a $25 fixed deposit for the next 20 years.
And then the next question coming from there is, what happened to the principal?
Okay, so for instance, day one, we borrow $75, okay? Now, on your exit point, maybe say 20 years down the road, okay, you will need to pay back the bank $75 at your exit point.
Correct.
Okay, by then your property will have appreciated
More than 75,
yes,
yeah, more than the 75%
then you just pay it back
portion.
subsequently.
Correct. Now, last questions. How do Capricorn Financial help a client from day one, say from step A to Z, when they want to apply a UK mortgage?
So at Capricorn, right, we are the mortgage brokers. We are happy to engage with any potential buyers who are exploring a purchase, okay, at the very early stage. We can help you identify what is your borrowing capacity is like, etc., etc. Okay. Once you've stepped into a purchase and exchange of contract, okay, we will prompt you accordingly on what's your options like, okay, all the way until your key completion date. Okay, we'll provide you with solutions. We'll guide you through what are the things to do and provide, and even actually handheld you with the legal process that we require from the legal drawdown.
Understood. And do you charge a fee?
Yes, we do charge a fee, okay, and the fee is only chargeable upon the loan offer being generated, okay. Our fees, depending on cases, it starts with £1,500 net.
I see.
And this is only chargeable upon the offer being generated.
Irregardless the mortgage amount.
Yes, that's correct.
And what is the difference between your fee and arrangement fee? There's an arrangement fee in the fee schedule. What are these two fees for?
Okay, so an arrangement fee is a fee whereby lenders will levy on what the loan is being drawn down. Typically, it can be from 1% to 2% of your borrowed amount.
Okay, and that is being lumped into the whole mortgage sum, or it has to be paid separately?
Depending on the lender, okay, some do offer the option of actually adding on to your loan, or some you are required to pay before the loan is being drawn down.
Understood, understood. That pretty much ends our interview today. I'm sure there will be a lot more following questions for Brendan as well. So we're going to do perhaps some follow-up series with Brendan another day. But if you have any question, you can drop a message to us. I would also share Brendan's contact details at the end of the scene. So stay tuned for the next episode. Bye-bye.
Bye-bye.